45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Alrighty, so welcome everybody tonight. Thank you so much for joining us. Tonight's presentation, how successful investors are buying property in today's market. Really excited to just kind of cover what we're doing here at Marshall Reddick, some of the things we're focusing on, and what maybe you can take from this and implement yourself. So before we get started though, I just wanted to make a quick introduction. My name is Vince Tomich. I'm an advisor, I'm an agent here at Marshall Reddick. I've been with the company now for just over 6 years. I work in Newport Beach. Primarily what I focus on as an advisor is I deal with a lot of our inbound clients who are maybe being introduced to Marshall Reddick for the first time. And I get a better understanding of their goals, of what they're trying to achieve, whether that's buying a primary residence, whether that's buying an investment property, whether that's property management, whether that's borrowing money or lending money, right? So I'm going to get into a bit more of our services on the next slide, but ultimately I'm one of the first contacts that one may make here at Marshall Reddick, and I can help guide you into the right direction based on what your goals are. Born and raised here in Southern California. In addition, of course, to being an employee of Marshall Reddick, I'm also a client, right? So I practice what I preach in the sense of I own rental property. I have Marshall Reddick manage that property. I have borrowed money. I've lent money with Marshall Reddick. So I've done a lot of I've participated in a lot of the services that we provide. So I can speak from experience of a client as well as, of course, an employee. And then I have a background prior to my role here in residential mortgage lending. So that has become very useful, of course, in the work that we do here. So for those of you that are unfamiliar with Marshall Reddick, this is always a good time to just kind of explain who we are and what we do. I did see a lot of new names, made some phone calls today, so some of you may have already heard from me. But I like to describe Marshall Reddick as a full service real estate firm. Essentially, we have 4 different services that we focus on. So we have our real estate brokerage, where we help people buy and sell. Whether that's a primary residence or an investment property, we can help on both ends. We're also a property manager. So 99% of the folks that end up buying an investment property with us are going to need property management services. It's such a critical component to the investment process. And we handle everything from marketing the property for rent, all the showings, the background checks and screenings for the tenants, rent collection, rent disbursement, any kind of maintenance or repair request, as well as all the tax documentation at the end of the year. We can handle all that on your behalf. Next is we're a private money lender. So not like your conventional loans that you would get to buy your primary residence or maybe long-term investment property. These are going to be more short-term financing solutions, or even solutions maybe for your self-directed IRA. So I can give you some example of people that borrow money from us, or that would make sense to borrow from us. So we do a lot of fix and flip loans. So people who are buying a property to renovate and then sell. Some people use the acronym, the BRRRR method, right? So that's a great example. Buy, renovate, rent, refinance, repeat. That is a good example of someone who uses our renovation loans. There's also folks that may need bridge financing, right? You may need short-term capital in between deals. That would be a good resource for us. Or if you have self-directed retirement accounts and you want to buy property in those self-directed retirement accounts, like for example, I have a solo 401k and I was able to purchase a property in that retirement account. You need non-recourse financing, which would be an example of us here at Marshall Reddick and how we, the type of lending we do. So those are all kind of examples of who borrows from us. Now on the flip side of that, we have the opportunity for you to lend money. That's what brings us to our next service, investment funds. So there's actually 2 ways you can lend your money to those exact borrowers that I just described. the most fruitful way or the most common way of doing that is through our investment fund. So we have a pooled investment, me and let's say 300 other capital partners that have contributed to our mortgage fund. Our mortgage fund is now close to 70 million, and we use that fund to originate and fund the various loans that I just described, right? And the beauty about investing in the mortgage fund is, it is a great source for cash flow. You get quarterly distributions, and you don't have to deal with maintenance or vacancy. And the beauty of it is it's all managed by us. So you're not investing in one project or one deal. In the unlikely event that there's any issue with that loan, that won't have a direct impact on you. When you've now invested in the fund, you've spread your risk amongst hundreds of loans. So that's a great way for those of you that are seeking cash flow or looking for a higher yield or more consistent yield than maybe buying property or the stock market or alternative options that may be available. You can always lend your money, and I'd be happy to talk with you folks about any of these services. I'm happy to go into more detail, but just for those of you that are learning about Marshall Reddick, that is what we can help with. So as I mentioned, I'm in our office here in Newport Beach. We do have a brick and mortar, or at least a footprint, in all of the major cities that you see here, right? So we are in California, Texas, Tennessee, and Florida. And as you can see, we are growing rapidly in a lot of markets, especially Texas, with Dallas and Houston being some of our newest markets that we have that are available to us. So a little bit more about our geographical footprint here. Now, tonight's webinar, what are we going to be talking about tonight on how successful investors are, what they're doing in 2025. So we have a couple of questions that we posed that we're going to go into more detail, which is, how do we choose a good investment market, right? I'm sure there's a lot of folks across the country that are tuned into this webinar, and not every single market across the country makes sense. And we'll go over some criteria of what we think solidifies a strong investment market. What are markets to consider in 2025? So what are markets that Marshall Reddick can actually help you get into in 2025, where we can be a start to finish involvement, right? We can help you from the brokerage, the property management, and everything in between. And then what are investors doing to overcome the interest rate environment? I'm sure for those of you that have been looking at real estate, you've been made aware that interest rates are not like they were in 2021, and that's making the numbers sometimes difficult to make sense. So there are some solutions and some tactics that we've seen that have helped investors overcome that obstacle. So we'll go over some of those tonight, as well as some of the key components of why using a property manager is so important. I think at the end of the day, you can do a really good job of identifying a market, buying a quality property, getting all the financing lined up, and then trying to self-manage that across the country. You can really let all of those wins go to the wayside by poor management or by trying to self-manage maybe from an unreasonable distance. So why we leverage and why we lean on our property management so much, we can go over that. And then we wanted to cover something that's new, right? So there was a new tax bill put into law as of July, and there's lots that are involved in the tax bill. And I want to start and kind of make sure everybody knows I'm not a CPA, so I don't take any of this as tax advice, but there are some really crucial benefits that are now eligible for real estate investors, and I just wanted to go over those and kind of dive in a little deeper dive into what that can mean for you, for somebody who's maybe taking advantage of investment property in 2025. So our first question is, how do we choose a good investment market, right? So that's kind of top of mind for a lot of folks. Where are we looking? What are we using in terms of metrics to identify those markets? So here's some of those metrics that I mentioned. I would argue these are all really, really crucial to establish or to move forward in any given market. So population growth as number one. that is critical, right? You want to make sure that there is an upward trend in population growth. People are moving to that state. There's demand to buy there. There's demand to rent there. So seeing that population growth increase is is an important factor. Now, when you have great population growth, what else are you going to need? You're going to need job growth. You're going to need employment there, right? So that all the new people that are going there, they have jobs. There's some way for them to make an income, right? So that's really important. And to piggyback off of that is you want economic diversity. You don't want to lean on one industry, right? As you can, by leaning on one industry, you leave yourself very vulnerable for, if there's any issues with that industry or anything goes awry, it could become problematic in the future. For those of you that are, like me here in Southern California, housing affordability is a problem. So finding markets that are, investor friendly, I would argue, is making sure that they're affordable. So we do seek out markets that have a reasonable price point where we can get that rent to price ratio a bit closer, and ultimately, find some cash flow for you. Also, really important, landlord friendly. So again, not to keep picking on California, but California is definitely not a very landlord friendly state. And for those reasons, there's a lot of investors that seek to purchase property outside of California. So we do have, the states that we focus on, Texas, Tennessee, and Florida. Those are all very landlord friendly, but ultimately, that's something that's important. And then good infrastructure, right? Also having, business expansion. Those are all really good, important factors to consider when you're looking at a market. So in addition to that criteria that we just went over, what you're going to notice too on our website is we have a very helpful interactive website that allows you to look at our pro formas and our financial calculators and on all of our properties that we have. And what you'll notice as well is you'll notice a property class designation on each one of our properties. What does that mean though to you? Like, what does luxury to D class mean? So we have this chart here that's really helpful. It helps kind of break this down. We also have an ebook that I'd be happy to share that breaks this down into much more detail, and it's really helpful to read for any of you folks that may be interested. But ultimately, we're going to be focusing mainly on A and B class properties. That's pretty much what you're going to see at Marshall Reddick, the majority of those being A class properties. Because our model is more long-term buy and hold. So that's the reason why we feel like the A-class property is something that we typically focus on. And you'll see this sliding scale here. So as you go to the left, A-class and luxury, you're going to notice there's more appreciation. You're going to notice there's a higher purchase price, and typically what comes with that is a higher tenant quality. Vice versa, right? If you go towards the C and D class properties, you're going to notice there's actually more cash flow, assuming that they're paying, right, and paying on time. You're going to notice there's a lower purchase price and lower tenant quality. So it's kind of a ebb and flow here. It's like depending on what your goals are with your investment strategy will determine on what property class makes the most sense for you. In addition to property class, we make some assumptions on maintenance and vacancy. No one can perfectly forecast what maintenance and vacancy will be at the end of any given year. Those of you that own real estate understand that more than anything. Sometimes there's years where you actually have no problems and everything is smooth sailing and you don't hear from the tenants. And then there's other times where you have unfortunate circumstances and there's either a series of constant repairs or maybe even just a few large repairs that really set you back. So maintenance and vacancy is one of those things that we do have to estimate. So we make these assumptions based on property class, based on maintenance and vacancy. So you'll see for our 1 to 4 unit properties, we have A class, we estimate 8% maintenance, 8% vacancy, B class 10 for each, and you'll see C class 13 for each. For the 5+ multifamily, there's a slightly different assumptions made there, but you can see how as you get into higher property classes, you typically have less variable expenses, which is what we'll call these. And as you get into the lower property classes, you'll have higher variable expenses. And when you factor in those variable expenses, oftentimes you'll see that this cash flow that you might be seeking gets eaten up. And therefore, you might realize that in the long run, appreciation tends to be the component that really creates the most wealth in real estate, right? And some people have different strategies, but that's kind of been our approach and our guidance on for a lot of investors. Okay, so what are strong markets to consider in 2025? Now, I'm well aware there are more than just these three kind of areas to focus on in 2025, but these are areas that we here at Marshall Reddick can actually make an impact, right? We have boots on the ground, agent brokerage, property management. We have many resources to help with this. So for those of you that are maybe considering some of these markets, I'm going to go into a bit more detail as to why these markets are advantageous for investors and break that down a little bit more. So Central Texas. Now, when I say Central Texas, we have offices in San Antonio to Austin. So a lot of times what I'm talking about is that I-35 corridor in between those two major metropolitans. I really like the Central Texas area because of that reason, right? You're wedged in between Austin and San Antonio, both in the top 5, cities in terms of size in the state of Texas. So explosive population growth has been, ongoing. Austin has been on that chart for many years. Not to mention its proximity, to San Antonio and the inflows as well in San Antonio. But there's also, just a booming job market with Tesla, Apple, Samsung, Dell, Oracle, Amazon, Toyota, right? There's tons and tons of major employers there. In addition to that, when we look to San Antonio, which also has tons of medical and it's home to 5 military bases, there's just plenty of residents that need rentals, right? To kind of piggyback and to continue on kind of on the tailwinds of Austin, but there's a very strong educated base of renters. So as you can see here, there's multiple universities, UT Austin, Texas State, UT San Antonio, and basically, a lot of folks that end up graduating from these schools, they tend to get employment there and they want to stay, and they're usually renting. So you do have that strong and educated rental base there. And, the key word there is educated. You're getting out of these good schools. You typically have a good job and you can support, a nicer rent. So these are all really good factors that help support our advice for Central Texas. In addition to that, Texas is one of the most landlord-friendly states in the U.S. There is no rent control there, which is very helpful. So, you're in a really good position there for those of you that may be in markets or states that do face rent control. You don't have to worry about that in Texas. Now, cash flow opportunities, that's a hot topic. There's so many folks that I talk to, and their primary driver is achieving cash flow. And I don't think it's a secret. That is a very tough metric to achieve in this market, assuming you're buying in A-class properties in kind of major metropolitans, right? One of the ways to better achieve that is sometimes stepping away from the core of those major metropolitans. For example, Austin even today is a tough market to cash flow in, right? It's definitely more appreciation based. So you focus on some places on the outskirts, for example, like Kyle or Buda, and I actually have an awesome property in Buda to showcase later in the presentation. But like San Antonio does have a good opportunities to cash flow, but you'll see the same there in New Braunfels and Seguin. There's these cities kind of on the outskirts of these major metropolitans that help promote a bit more cash flow. And then of course, lots of business investment going on in Central Texas. Samsung's $17 billion chip plant in Taylor. You have Tesla with the Gigafactory and Apple's campus. These are all creating lots and lots of demand for rentals as well as for purchases, right? So it's helped kind of driving that appreciation trend. Now, Dallas, Dallas is a newer market to us. So we're seeing a lot of interest for the folks that have kind of been with Marshall Reddick for a lot longer and have already, looked at opportunities in San Antonio and Austin. We're really happy to be able to promote Dallas as one of our upcoming markets, at least for us. Dallas-Fort Worth is the #1 metro in the U.S. for population growth, with 130,000 people year over year. So that's amazing, right? That was one of our top metrics, is population growth. So there's no lack of that in Dallas. And of course, there's huge employment players in Dallas, right? You could just read a few of these names. I'm sure everybody has heard of these. These are all household names, right? So tons and tons of employees to be able to, that need housing. So, and then what I've noticed while looking at all of our properties on our website amongst, San Antonio, Austin, Houston, and Dallas, is Dallas has the highest average rent. I've noticed that even if we have a great multifamily, a 3-unit to also showcase in a few slides. And it definitely has the highest rent in probably any of our Texas, Texas properties. So, and I would say on average, Dallas does support that higher rent, which is great. High liquidity. So one of the most liquid real estate markets in the country, like I said, with a lot of buyers and tenant demand, that helps keep, transactions going and kind of keeps the pace and keeps that growth for rent and for purchases. Okay, so Middle Tennessee. Again, when I refer to Middle Tennessee, the two areas that we're primarily focusing on is Clarksville to Nashville and everything in between. We will go off and into some outskirts, into the outskirts of those of those cities as well. But that's where we're seeing a lot of the where we're able to help and with our bandwidth. So Clarksville and Murfreesboro has ranked fastest growing cities for the past few years. Lots of jobs in central or in Middle Tennessee. Amazon, Nissan, Oracle, those are some of the main hubs. There's a big healthcare kind of push in growth in Clarksville. Also, for those of you that are unfamiliar with Clarksville, Clarksville is home to Fort Campbell, which is the 2nd largest military base in the country. So tons of military tenants that we have access to that are paid by the government, which is a great employer. It's that's factored into their base pay, so you'll always have a budget for that. And then, like I mentioned, there's a lot of business expansion here too. Oracle and Amazon building their data centers and also attracting large manufacturing and fulfillment centers. So there's a lot of big industrial type of employment there, blue collar type of jobs, folks that may just be more comfortable renting long term, and these are great opportunities to provide that rental housing, right? So lots and lots of good things going on in Middle Tennessee as well. Now, as I alluded to earlier, there's no secret that it is tough to make some of the numbers work, especially from a cash flow standpoint. Those of you that are primarily focused on cash flow, you've probably run into this problem. And one of the components that's disrupting cash flow right now is interest rates. Interest rates being where they are has definitely compressed that cash flow margin. So what are investors doing to overcome that? What are some ways that people are still making purchases and being successful at acquiring real estate? So the first and foremost, and something that I'm the most, I would say, excited about is a term called a forward commitment financing. So I can explain this. It can get a little, I guess, technical, but I'll do my best to explain this in a the simplest way I can. Ultimately, I'll use an example. There's a lot of national builders that you may notice that when you look at purchasing a property with them, they always have some very, I would say, incentivized financing, right? They have interest rates much lower, much lower than what the market rates are. And how do they do that? How is that possible? Well, a lot of times those major national builders have a financing arm, And what they're doing is they're able to either just take a loss on that financing because it's ultimately rolls up to the same kind of entity, or maybe they take a loss from the building and just pay for the financing. So there's a way for them to work together, but that's usually at a large scale. We're talking national builders, the KB Homes, the Lennars, the national builders of the world. We work with a lot of independent or small local builders, and we do that because we find that we get a really good quality of the build. But the challenge that we were facing is we weren't able to compete with those financing options that were being provided from the national builders. So we created a path to replicate what these national builders are doing by offering these very much incentivized rates, which is called forward commitment financing. And the way it works is we have a preferred conventional lender that we work very closely with. We have a 20-year relationship with this conventional lender, and they've been absolutely amazing in pivoting and adjusting to the market conditions. And what we've done is we've created business relationships with builders and our conventional lender. And there are guidelines that says a seller or a builder can only contribute so much to a seller in the terms of a seller credit. But when a builder and a lender are working together before any transaction, there is no limit to what a seller can contribute. So in these cases, when I say a seller to contribute or a builder to contribute, what I mean is they are typically contributing funds, and we're using those funds to buy down interest rates. But if we had to do it based on the limitations in a normal transaction, we would have very little wiggle room. But being that these are business to business transactions, we have no limit. So you're going to notice I have a couple of properties. They all have forward commitment financing, and they're going to range. They're going to range from 3.75, which is the most aggressive, to 5.25. Why do they range? Why are they at such different rates? Well, it's because the builder is deciding to offer different amounts, and that's based on their personal margins of the property, right? So we have 10-6 arms available as well as 30-year fixed options. 10-6 arm, what a 10-6 arm is that rate is fixed for 10 years, and then it becomes adjustable year 11, and that can adjust every 6 months. The benefit of forward commitment financing is it dramatically increases the investor cash flow. Not only that, it's, in my opinion, the best use of that capital or credit that the builder is offering. I've run the math many times, whereas if I were to say, okay, this builder is going to offer $30,000 for a concession. Well, if I take $30,000 off the list price and still have a 7% interest rate, it moves the needle very little from a cash flow standpoint. If I take that $30,000 and I buy the interest rate down from a 7 to a 3.75 or a 4.25 or a 5.25, those numbers dramatically improve, right? So we've been able to identify that as the most useful way. And for those of you that may be using cash, we totally can use those credits to reduce purchase prices or other things like pay for closing costs. So for those of you that don't use financing, there's other ways to take advantage of that as well. But this is probably one of the main strategies that we are using in targeting new construction. In addition to that, outside of new construction, you're going to see more opportunities for seller financing. This is where the seller acts as the lender, allowing the buyer to make monthly payments to the seller direct. So there's no guidelines there. This is very helpful. Maybe if a seller doesn't want to take this large capital gains hit all in 1 year, you can kind of spread that income over time. There's what's called DSCR loans, debt service coverage ratio loans. So these aren't like your conventional loans where they're based off of you as the individual. A conventional loan is typically focused on you as the individual, your credit, your income, your bank statements. DSCR loans are more focused on the property. So they want to know the cash flow from this property. They're more concerned with loan to values and how much you're going to put down and the cash flow that this generates. They want to make sure that the rent covers all of the fixed expenses, right? So that makes them more ideal for investors, and it's a bit more of a streamlined process. So that's something that folks are taking advantage of. And then lastly, and this is more of a super niche scenario, but assumable loans. So there are a few loans that maybe were originated, let's say in 2020 to 2022, right, where there was at the bottom the extremely low interest rates. So folks are those that have government loans, whether it's a FHA, VA, or USDA loans, right? Those could be considered assumable loans, and ultimately you can purchase a property, or you can assume that seller's existing financing, especially in a high rate environment like ours. There's a few caveats there. There's a few points to mention that kind of make these tougher to find. One of them is usually you have to come in with a down payment that is the seller's equity position. So that sometimes is larger down payments. But nonetheless, this is a strategy that we're seeing people use is assuming loans at lower interest rates. Now, as I mentioned earlier, there's a few properties that I have here that I wanted to showcase for to show you examples of this forward commitment financing. So this is my first property that I wanted to show. And I'm going to go through this one kind of more line by line, and then the other few will kind of move through a little quicker, but at least this way you'll get a pulse of how this works. Now, this is our financial breakdown, and on our website, you'll be able to toggle and edit all of these numbers. Given that this is a presentation, I have this in a PDF form, so these are fixed here, but you can manipulate and move numbers around on the website to kind of change and toggle to see what certain, by making adjustments, seeing different returns and different cash flows. So this is a new construction build, purchase price $623,500. We assume a 30% down payment. The minimum down payment for multifamily and investment multifamily, so 2 to 4 units, is going to be 25% down. Although we have 30, is typically you get a little bit better rate / lower costs on financing. So yes, we have that 30% down. Then we have our closing costs in there. We have our rent, and you'll see we have our, there's 6.875 rate crossed out because we have our forward commitment financing, and in this particular scenario, it's down to 3.75. So you'll see with taxes, insurance, management fee, HOA, you have your fixed monthly expenses at $34.30, which leaves you with a monthly income before variable expenses at $459, right? So this is traditionally, if the rent is paid and there's no maintenance issues, this is what you would expect to receive every month, $459, right? Right below, you're going to see estimated maintenance and vacancy. Those are things like I mentioned earlier in the presentation. The reason that this is estimated at 4% maintenance instead of 8% is because it's new construction. Everything is brand new, of course. There's builder warranties, so there's very, very little that would have to be covered, especially in the first few years. So that's why you have that kind of tapered down. So when that's all said and done and you back out your maintenance, your vacancy, and your leasing fees, you do have a slight negative, but that's year one, day one at closing. At the end of the day, one of the benefits with buying rental property is usually you're going to get those rent increases. I'm not going to say that every single year that's going to happen without, any hesitation. For example, right now, across the country, you're not, there's many markets that are not seeing that, and it's probably wise to keep better tenants and not try to raise rents. So, we're seeing that in a lot of places in Texas. So I would say, like, for the first year or two, you might have the same rent, but typically when you look long term, you usually have a pretty solid rent growth, right? So that's something to point out, right? A lot of times people look really short term in real estate, but when you look long term, 5, 10, 15 years, the numbers don't lie in terms of the trajectory, in terms of appreciation, rental increases, etc. But you will see that we have an annual, like a projected 15-year hold for our properties. This is like a default setting in the calculators. You can always readjust this to any amount of time, any time frame you want. But if you were projected to hold this property for 15 years, you would have roughly $693,000 in profit. So that's going to factor in your cash flow, your appreciation, your principal pay down, and your selling expenses to overall net that number. And that would basically return you an annual average of 23% based on this down payment and this capital needed to purchase this property, right, on a 15-year hold. So that's how these numbers work, and I'd be happy to go into more details and questions for anybody who wants to on a one-on-one basis. But we'll kind of go through to the next property as well, just to take a look at a few other options. Here's a property in our Dallas market, so Midlothian. This is about 30 minutes from the Dallas-Fort Worth Airport. So this is a 3-unit. So this property is $975, 30% down. You have your closing costs and your rents. You'll see your rents are significantly higher here. So your gross rent $72.60. You'll see here that gives you a monthly income before any variable expenses of just over $1,000, $1,048. And then when you back out your maintenance, vacancy, and leasing fees, you'll have a slight negative year one at negative $24, right? So very easy to overcome that, especially with 3 units, right? You have economies of scale. That was something that I realized on my first duplex purchase was, even a small rent increase, $50, or in my case, it was $100, but at purchase, the property was just breaking even. Because I was a little bit behind market rent, I was able to raise each side $100, and just overnight, it's $200 more, of cash flow that I have. So as you scale up in terms of doors, those smaller rental increases can really do numbers on the whole pro forma, right? Those smaller increases do add up. And you'll see here projected profit after 15 years, $971, and an annual average return on investment of just over 20%, 21.15. So this property, for example, has an interest rate buy down of 5.25. So like our last example had 3.75. This has 5.25. And like I said, this is a builder to builder preference based on their margins and what makes the most sense in that market. Okay, lastly, we have a single family home here in Clarksville. This property, new construction, $320,000 purchase, $1,800 a month in rent. This interest rate buy down is 4.75. So when you back out your taxes, insurance, management fee, HOA, you are left with monthly cash flow of $157.52. And then you'll have a slight negative after all variable expenses are factored in there. And then you can see our profit and our annual return on investment over that 15-year hold. So another example, but basically I wanted to show you guys some of the examples of how the forward commitment financing is actually applied, what it looks like, what some of those numbers look like. We don't exclusively sell new construction. We can help you buy pre-owned homes. We can help you buy homes that you find yourself on Zillow or Redfin or any other website that you find. We function as a normal brokerage, but we do have some of these unique opportunities, particularly in the new construction space. And particularly, one of those advantages is targeting that kind of forward commitment financing. So that's something that I would say is unique to Marshall Reddick and stuff that we are sourcing through small local builders as opposed to what's offered at the national builder level. This is our preferred lender, Reed Hazard at CMG Financial. Reed, like I mentioned, has been with our company for 20 plus years. This is just a quick pre-approval checklist for those of you that are unfamiliar with the process. I'm more than happy to make that connection to allow you to connect with Reed, ask questions, go through the process. This is definitely the first step that I recommend in just getting an understanding of what is entailed in this process and what you need to be prepared for. So this is always a good phone call to have, is with Reed. Okay, why use professional property management? You were able to identify an awesome market. You got a great deal. You got great financing on the property. But then what? Then you either hire someone that is not a professional property manager, or you're trying to manage it yourself. So there's a laundry list of things that property managers do, and I can go slide after slide with bullet points. I have a couple of key terms here. Ultimately, I'm just going to kind of summarize this by the last two slides, or the last two bullet points, which is enforcing the lease. That is ultimately the job of the property manager. We're going to establish a lease. We're going to set terms. We're going to make sure that everybody knows what they're supposed to do and what we've agreed on, and then we're going to enforce that, right? There's so oftentimes you have an agreement, and if you're self-managing, maybe you develop a relationship and there's kind of a little bit of an uncomfortability to enforce certain things that are, not that rules that are being broken, or terms to the lease that are not being followed. We don't have that issue, right? We are a professional company that stands in between two parties. In all of our scenarios, our owners don't ever meet the tenants, and vice versa, just to eliminate those kind of circumstances. So enforcing the lease is key component here. And then ultimately, knowing all your rental laws, knowing all of your local, everything going on locally, that things are changing constantly. So especially in a more tenant-friendly state like California, it's really, really important to know all of those laws and changes in keeping you out of court. That is truthfully one of the other main components of our job as property managers, is to ensure we force the lease, keep you out of court, and just keep your income coming in and keep those expenses down. That's definitely the goal of us as a property manager. We have just some bullet points all over the map here in terms of where we're centralized. So you're going to see a lot of management in Southern California, in the San Antonio, Austin, Houston, and Dallas markets, as well as Tennessee, all markets that we've been describing, as well as in Southwest Florida as well. So over 3,000 properties under management and in climbing. So I want to close out by talking a little bit about how the new tax law can be beneficial to real estate investors. Again, one of my key notes here is that I am not a CPA. So please consult with your CPA to go into any specific details here. But I do want to break down an example and one key component, which is bonus depreciation has been restored and made permanent. That is a huge component. This is something that I personally took advantage of a few years ago, and it's completely changed my mind and kind of my eyes to owning real estate and how it can be such a crucial tax strategy, right? So let's take a step back and let's go ask, what is bonus depreciation? And to figure out what bonus depreciation is, we have to understand what depreciation is. So depreciation is a tax deduction that spreads the cost of property over an asset over several years. So ultimately, in the eyes of the IRS, you buy a piece of property, and the home is comprised of many different components. All of those components deteriorate over time. The wood gets older, the nails get rusty, the roof wears and tears, etc. Right? Things basically deteriorate over time. So there is a way to formulate how much of a deduction you can take. And typically, if you're a real estate investor, you're taking like a straight line depreciation, which is typically over 27.5 years. Right? And you're just taking that year over year, right? Even if the home's value is going up on your tax return, you're showing that there's a depreciation or a loss in the fact that things are deteriorating year over year, okay? What bonus depreciation allows is it allows you to take 100% of the cost of certain assets immediately in the first year rather than over time, rather than over that 27.5-year basis. Now, why is that important? What are the key benefits to that? So one is big first year tax deductions. You can write off up to hundreds of thousands in year one, right? Which is incredible and something that I saw with my own eyes, and it made a huge difference. What does that do for you? That's going to increase your cash flow. You're going to owe less in taxes equals more cash in your pocket to reinvest or whatever else you decide to do with that capital. It reduces your taxable income across your portfolio, so you can use depreciation from one property to maybe offset income from others, right? So you can really kind of control the expenses you have in that particular bucket in your tax return. Last point here, which is probably the most crucial when you're talking about bonus depreciation, is it can offset W-2 income if you're a real estate professional. It can reduce the taxes on you or your wife's salary or business income. So now keep in mind here, the key term is real estate professional. If you are designated as a real estate professional, the bonus depreciation tactic can really maximize tax savings and opportunities in terms of tax strategies. This may look complicated. I'm going to do my best to break this down as simple as possible, but I wanted to provide an example for those of you that are tracking or that are following here to better understand what I'm explaining. So if you were going to buy, let's say, a new construction duplex for $650,000, you break that up into two components: land in the building. The land is non-depreciable, so you take that off the table. So 650 minus your 100,000, you're left with 550,000 of a building. That's a depreciable portion. Okay. Now you go through what's called a cost segregation study. This is what breaks down the lifespan of the various components of that home in 5, 7, 15, and 20 plus year life, life expectancies. So what a cost segregation study will do is identify anything from 15 years below, and that is what you can use to come up with your bonus depreciation. So if you have, let's assume that 25% of the building is considered in that 5 to 15 year window. 25% on 550 leaves you 137,500. This number would qualify as bonus depreciation. So you can write off $137,000 in deductions in year one. Now, in addition to that, 137 off of 550 leaves still a lot of value there, 412. That though is considered long-term, and that you'll have on the straight line basis. So that's going to go year over year. So 412 now is spread over 27.5. That leaves you 15,000 in annual depreciation year over year. So now you can combine those two for year one, and you can see how these first years can be incredibly beneficial. It's, like I said, especially at that, if you're considered a real estate professional, and being able to really offset, especially high income years. So 137 plus that 137.5 plus that 15,000 is going to leave you with 152,500 in total year one potential depreciation based off of this example. Assuming you might be at a 35% tax bracket, 152,500 would translate to 53,375 in potential year one tax savings. Now, this can be used to offset income across your portfolio, or again, coming back to the real estate professional category, it can offset your income as a real estate professional. So it would ultimately lower the amount of tax you're paying on your ordinary income that you're making, which is a huge game changer for those folks that are in that space, and being able to really take advantage of some tax savings there. Okay, now again, happy to go over this in more detail or break this down or connect you with professionals, tax professionals, cost segregation professionals that can actually outline what this could mean for you. I definitely just wanted to use a general example, use kind of round numbers, things so that we can understand the concepts. So with that said, given that we are, a big part of our business is education, and those of you, I'm assuming, that are here tonight are interested in that education, we do offer other previously recorded webinars you can find on our website, all for free. There's articles, there's guides that we write, we have market data packets, there's lots and lots of information. Here's a quick snippet of some of our property management kind of fees and terms here. This is for our outside of California markets. But happy to go into more detail, or if there's a particular topic you're looking to learn more about, I can help with that. Here's the contact to Reed Hazard at CMG Financial. This is our preferred conventional lender who's helping us achieve and complete all of our forward commitment financing scenarios that I outlined. He's just a wealth of knowledge for all financing questions, so this would be a great person to reach out to for all of your conventional loan inquiries. This is my contact for all things Marshall Reddick, whether it's brokerage, property management, private lending. If you're looking to invest in our mortgage fund or lend money with us, happy to go over that. I'm also happy to make various contacts in whatever situation you're in, 1031 exchange, tax professionals, cost segregation, etc. Right? Insurance folks, whatever it is you might need, I'm happy to make those introductions and leverage our resources. So we are very, very grateful for everybody to be on to tonight's presentation. It's always a pleasure, and I really do appreciate the time that everyone spent, and I hope everybody enjoys their evening. I did see a question, will this presentation be sent out? Yes, it will. I'm happy to get you the slides, and this recording will be sent out. So thank you guys so much. Appreciate the time, and have a great night.